Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest ING updates and digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon and 7 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Ladies and gentlemen, what if the market is completely mispricing XRP? Not by 10%, not by 50%, but by an entire financial era. Because while most traders are staring at candles, leverage, and Bitcoin dominance charts, something much bigger may already be happening underneath the surface. Stablecoins are being minted on the XRP Ledger at record sale. Governments are quietly building tokenized money systems. Energy markets are being tokenized. Artificial intelligence is accelerating faster than expected. And institutions may be preparing for a financial infrastructure shift most retail investors still do not fully understand. Meanwhile, XRP is still trading like none of this matters. And that disconnect could become one of the biggest stories of the next decade. Let that sink in. Because short-term noise is loud, but long-term structure is where wealth is built and it's quiet. Right now, XRP exists in one of the strangest positions in the crypto world. On one side, you have one of the most battle-tested digital assets in the industry. Years of regulatory pressure, years of public scrutiny, years of surviving attacks that would have destroyed many other projects. And yet, despite all of that, XRP still hasn't returned to its previous all-time high in a meaningful way. For many investors, that creates frustration. For others, it creates opportunity. Because this market has become increasingly irrational. One tweet can move billions. We always go over this. One geopolitical conflict can wipe out weeks of momentum. We touch on this every day. One Federal Reserve statement can instantly change sentiment across every asset class, ladies and gentlemen. That's why people are being cut up like sushi. And XRP, the anointed one, has been trapped directly inside the uncertainty. The Ripple versus SEC case didn't just affect price action. It froze momentum. It created hesitation among institutions. It scared retail investors. And it delayed adoption cycles that many believed would arrive years ago. But here's where it gets interesting and spicy. Markets often confuse delay with failure. Those are not the same thing. History shows this repeatedly. During the construction of the Transcontinental Railroad in the United States, investors initially believed many railroad projects were disasters because they took longer than expected and burned enormous amounts of capital. Yet once the infrastructure was completed, entire economic systems transformed around it. Cities expanded, trade accelerated, wealth shifted permanently. Infrastructure often looks inefficient before it looks inevitable. And that may be the key framework for understanding XRP today, because price is reacting, but systems architecture is evolving. Ladies and gentlemen, a growing number of analysts and market participants are watching 2026 closely. Not because of hype, not because of several structural catalysts may finally begin aligning at the same time. Regulatory clarity, institutional onboarding, tokenized finance, stablecoin expansion, cross-border settlement demand, and potentially the decoupling of utility assets from Bitcoin-driven speculation cycles. For years, almost every crypto asset has moved together. Bitcoin goes up, everything pumps. Bitcoin crashes, everything bleeds. But mature financial systems don't work that way. Oil doesn't trade based on gold. Banking infrastructure doesn't move based on wheat prices. Different assets eventually separate accordingly to utility, demand, and economic function. Write those down and let that sink in. That's why many XRP investors are watching for a future where utility-based valuation begins mattering more than speculative momentum. And one of the biggest possible catalysts could be regulatory certainty. The proposed Clarity Act has become increasingly important in crypto discussions because institutions do not like uncertainty. Banks can manage volatility. They can't manage competition. They can't even manage technological disruption. But legal ambiguity, that becomes extremely difficult for trillion-dollar institutions. Once rules become clearer, entirely new pools of capital could begin entering the digital asset space. Now, this is what most people miss. Institutional adoption rarely happens all at once. It happens in layers, quiet testing, small pilot programs, limited integrations, back-end infrastructure upgrades. Then suddenly, years later, the public realizes the system already changed. That's how major financial transformations historically occur. History doesn't move in straight lines, ladies and gentlemen. In the late 1600s, the Bank of England helped formalize centralized monetary systems that eventually reshaped global trade. At the time, many people resisted the transition away from fragmented local currencies and informal settlement systems, but over time, standardized financial infrastructure became essential for scaling commerce across nations. The world resisted modernization until modernization became unavoidable. Historical shifts resemble what may be happening with blockchain-based settlement systems today. Not identical, but structurally similar. Traditional banking rails were designed for a slower world, a world before instant global communication, before AI-driven commerce, before tokenized assets, before 24/7 digital markets. And now those legacy systems are colliding with modern technological speed. This is why Ripple's broader infrastructure strategy matters. Because the real competition may not simply be crypto versus crypto. It may be old financial plumbing versus programmable financial infrastructure. Write that down. This is extremely important. I spend hours drilling in this into clients' heads every day and the people that retain us. This is it. And that entirely changes the conversation. RLUSD may be bigger than most people think and realize. Recently, the XRP Ledger saw the largest RLUSD stablecoin mint in its history. 200 million RLUSD. That immediately triggered debate across the crypto community. Some investors worried stablecoins could somehow replace XRP's role, but Ripple executives clarified something extremely important. XRP remains the native gas asset of the XRP ledger. Every transaction still requires XRP. Every operation still relies on XRP for network functionality and spam protection. In other words, stablecoins operating on the XRP ledger could actually increase XRP utility rather than reduce it. Think about it this way. Ethereum grew massively partly because stablecoins exploded on its network. USDT and USDC became major transaction layers, and every increase in network activity indirectly strengthened Ethereum ecosystem importance. The same logic could potentially apply to XRP, but the implications may go even further. Some institutions cannot directly interact with volatility cryptocurrencies due to regulations, internal policies, or accounting restrictions. Stablecoins become the bridge, ladies and gentlemen, the entry point, the safer first step. Once institutions enter the ecosystem through stablecoins, they begin interacting with the ledger itself. That matters enormously because infrastructure adoption usually begins with the least politically controversial product first. This is how the internet evolved. Initially, corporations resisted full internet integration. Then email became acceptable. Then internal networks. Then cloud systems. Then digital transformation became unavoidable. RLUSD may function similarly, a gradual institutional onboarding mechanism into blockchain-based finance. Short-term noise is focused on price candles. Long-term structures focused on network integration. Ladies and gentlemen, if you're enjoying this type of breakdown, please do subscribe and like this video and join the Wolfpack. Never miss any of our updates as we build on every video that we produce 2 times a day, noon and 7 p.m. And if you make it to the end of the part, you get the candy from the Italian ice. I want to talk about the CBDC debate. It's far more complicated than most people think. One of the biggest political discussions emerging globally involves central bank digital currencies. The United States, several lawmakers continue publicly opposing CBDCs. Concerns including surveillance, programmable spending restrictions, financial privacy, government control over transactions. Those fears are not fringe concerns anymore. They've entered mainstream political debate. But while public opposition grows, international financial coordination continues quietly in the background. Projects involving tokenized wholesale money systems are still being explored globally through collaborations between central banks and private institutions. And this creates a fascinating contradiction. Publicly, many governments appear cautiously. Privately, financial institutions development continue accelerating. Now, this is where the conversation becomes uncomfortable for many people because stablecoins and CBDCs may not be as different as the public believes. Both are programmable. Both can potentially be frozen. Both operate digitally. Both can integrate with smart financial infrastructure. The primary distinction often becomes the issuer, private entity versus central bank, and that realization changes how many analysts view stablecoin adoption. Some believe stablecoins could eventually become transitional infrastructure between traditional banking systems and future digital monetary systems. Whether the future becomes fully centralized, partially decentralized, or hybrid remains uncertain. But one thing appears increasingly clear. Digital finance is not slowing down. It's accelerating. Tokenization may become the next massive financial industry. Let's talk about something most retail investors are barely paying attention to: electricity tokenization, because this could become one of the most important long-term developments connected to blockchain infrastructure. Energy demand is exploding globally. AI data centers require enormous computational power. Crypto mining continues consuming energy. Cloud infrastructure keeps expanding, and traditional electrical forecasting systems are struggling to keep pace with demand growth. That creates inefficiencies, and markets hate inefficiencies. The XRP Ledger is already being used in projects involving tokenized electricity production and energy assets reportedly worth billions. That is not a meme narrative, ladies and gentlemen. That is a real-world infrastructure experimentation. And if tokenized energy markets continue growing, blockchain settlement layers may become increasingly important. Why? Because energy markets are incredibly complex. Different producers, different grids, different jurisdictions, different settlement timelines. Programmable digital infrastructure could dramatically simplify portions of that process. But here's the biggest and bigger implication. If tokenization expands beyond currencies into energy, commodities, bonds, real estate, financial contracts, then blockchain networks stop being speculative ecosystems. They become operational infrastructure. That distinction matters a lot because speculative value can disappear quickly. Infrastructure value tends to compound over decades. Here's the psychology of XRP investors. Most of the most fascinating parts of the XRP community is psychological endurance. Many holders have been through multiple market cycles: bull markets, bear markets, regulatory attacks, exchange delisting, massive rallies, brutal corrections, lions and tigers and bear, oh my. Yet over time, investors often go through emotional phases. First comes excitement, yes. Then comes conviction, yes. Then doubt, the sky is falling, oh my God. Then frustration, I hate XRP. Then numbness, this is terrible. Then eventually long-term patience. This is where the Gucci conviction and Gucci clarity comes from, ladies and gentlemen. This is where you find it, in that place where you have your convictions. The journey is common across major investment cycles throughout history. But during the early days of Amazon, many investors sold because the stock collapsed repeatedly during the dot-com crash. Very few people held it through the full volatility. They lost their conviction and their Gucci clarity. The same occurred with Bitcoin. Early adopters endured crashes exceeding 80%. Most quit long before institutional adoption arrived. That doesn't guarantee XRP, the anointed one, follows the same path, ladies and gentlemen. But it illustrates something important. Transformational assets often experience periods where belief collapses before broader adoption emerges. And that's why many long-term investors focus less on daily price action and more on structural indicators: network activity, institutional partnerships, liquidity corridors, stablecoin expansion, regulatory developments, because price often lags. Infrastructure. Why consistent accumulation matters to many investors. Many XRP investors follow a simple strategy: gradual accumulation, not emotional chasing, not panic selling, just consistent positioning during uncertainty. That strategy comes from understanding how asymmetric markets work. When an asset has limited downside relative to perceived long-term upside, investors often prioritize position building over perfect timing. Of course, risk always exists. Crypto remains volatile. Regulations can change. Market cycles can extend longer than expected. But conviction-based investing historically rewards patience more often than emotional reaction. Now, this is what most people miss. The majority of life-changing financial opportunities feel uncomfortable while they are happening. When sentiment is euphoric, opportunity is usually smaller. When sentiment feels exhausted, confused, and uncertain, long-term position often begins. I go over this theme with everyone that retains us in any capacity or organization. This was drilled into my head on the floor of the New York Mercantile Exchange when I started at 15 years old. If you take one thing from our videos, write that down. That doesn't mean every struggling asset succeeds. Far from it. But markets repeatedly transfer wealth from emotional participants to patient participants. And XRP investors increasingly view themselves through that lens. AI is changing the world faster than expected, ladies and gentlemen. While crypto investors focus on charts, artificial intelligence may be reshaping the global economy faster than almost anyone predicted. Major corporations are already reducing workforce sizes aggressively, not because business is collapsing, but because automation capabilities are improving rapidly. Tasks once requiring teams can now be handled by algorithms, customer support, data analysis, programmable assistance, content generation, research workflows, financial modeling. The acceleration is happening now, not in 2035, not in 2040, now. And this creates enormous economic consequences because technological revolutions historically create both opportunity and instability. The Industrial Revolution massively increased productivity, but it also disrupted labor systems for generations. Factories replaced manual trades. Urbanization exploded. Economic power shifted dramatically. We may be entering a similar transition period with AI and digital infrastructure. That's the second major historical analogy investors should pay attention to. AI today resembles the early steam engine era. At first, people underestimated it, then suddenly entire industries reorganized around it, and blockchain infrastructure may become deeply connected to that transformation. Because AI-driven economies require faster data systems, faster payment systems, programmable settlement systems, tokenized machine-to-machine transactions, digital identity systems, and real-time financial coordination. The existing financial system was not built for autonomous digital economies. That's why conversations matter more than hype cycles. The quiet rise of digital financial systems. Look at the broader pattern emerging, ladies and gentlemen, globally. Digital IDs, stablecoins, tokenized assets, CBDC experimentation, AI automation, cross-border digital settlement, quantum computing research. Individually, these trends may seem disconnected. Together, they begin forming the outline of a completely new financial architecture. And XRP investors believe the XRP Ledger may eventually become part of that system. Not necessarily the entire system, but potentially one important layer within it. That's why the conversation around XRP increasingly extends beyond simple price predictions. It becomes a discussion about financial evolution itself. Could blockchain-based settlement eventually reduce banking friction? Could tokenized assets improve liquidity efficiency? Could stablecoins accelerate global e-commerce? Could interoperable ledgers modernize outdated payment systems? Those are the real questions institutions are asking. Not whether crypto Twitter is bullish today. And if those structural questions continue moving towards adoption, then the market may eventually be forced to reprice infrastructure assets differently. The future may arrive slowly, then all at once, ladies and gentlemen. For years, many investors expected crypto adoption to happen immediately. That expectation created frustration, but technological revolutions rarely unfold smoothly. Electricity took decades to scale globally. The internet existed long before mainstream adoption. Mobile phones evolved for years before smartphones transformed society. Infrastructure transitions move slowly until suddenly they appear obvious in hindsight. And XRP may currently exist somewhere inside the transition curve. Still controversial, still debated, still volatile, but increasingly connected to conversations involving institutional finance, tokenization, stablecoins, and digital infrastructure. That doesn't guarantee massive price appreciation tomorrow. It doesn't eliminate risk, and it certainly doesn't guarantee timelines. But it explains why many long-term investors remain focused despite years of volatility, because they believe price is temporary, while infrastructure evolution is structural. My final takeaway, ladies and gentlemen. Right now, crypto market remains emotional. Fear moves faster than logic. Narratives change weekly. Speculation dominates headlines. But beneath that noise, deeper transformation may already be unfolding. Stablecoins are expanding. Institutions are experimenting. Governments are researching digital monetary systems. Energy markets are being tokenized. AI is accelerating global change, and blockchain infrastructure is slowly integrating into the conversation. That doesn't mean every project succeeds or survives. It doesn't mean every prediction comes true, but it does mean the world is moving towards greater digitalization, programmability, and financial automation. And XRP investors believe the XRP Ledger could become one important part of the emerging system. The biggest opportunities in history often look uncertain while they were forming, and the biggest risks often overlooked safe right before change arrived. So while short-term price action may continue frustrating traders, long-term structural developments are what many serious investors are watching most closely, because price is reacting, but the system itself may be already evolving. The next few years, ladies and gentlemen, could become the most important of the modern financial history, not just for crypto, but for money itself. So the real question isn't simply whether XRP, the anointed one, goes higher. The real question is whether the global financial system is entering a transformation phase most people still underestimate. And if it is, today's volatility may eventually look very small in hindsight. If you enjoyed this breakdown, ladies and gentlemen, make sure you subscribe, ring the bell, turn on all notifications. Let me know in the comments. Do you think XRP eventually separates from Bitcoin cycle, or will crypto always move together? And as always, stay patient, stay informed, watch the structure, not the noise. The larger financial system may already be slowly repositioning underneath them. Like I say, short-term noise, long-term structure. Prices reacting, systems evolving. Ladies and gentlemen, make sure you join the wolf pack so you never miss any of our institutional signals and the structural changes most people overlook. But you got to always do your own research, and you never invest based on a sole YouTube video. I keep telling you this. I'll see you in the next one. Happy Friday, everybody. If you're already on the road for Memorial Day, you got some good stuff to listen to while you're driving. I'm going to welcome all the new members of our Patreon, the Crypto Republic Desk Monthly, all the new members of the membership channel. Remember, ladies and gentlemen, one good tip in the pits can pay for your entire year subscription. Come and join over 560 active traders and investors who've decided to take their own destiny into their hands. I want to talk about something real fast right now because, again, nobody wants to go long into a holiday weekend with action on the table. But U.S. stocks and bonds are approaching a breaking point as rising inflation, elevated oil prices, and hawkish Fed expectations pressure both asset classes simultaneously. I've been talking about this for the last 2 weeks. It warns that only a meaningful equity market sell-off is likely to lower bond yields, ladies and gentlemen, while deteriorating market breadth signals increasing vulnerability beneath major equity indexes. There's a lot of things happening right now. I'm trying to take the PhD out of PhD. So if you look at U.S. stocks and bonds, they're on a collision course. Only a meaningful equity sell-off is probably going to likely to pull bond yields considerably lower. And at some point, that's really got to happen. But global equity risk reward look very, very poor. Again, this is not financial advice, ladies and gentlemen. This is just my own opinion that anyone retains any capacity. The dollar, in our opinion, will stay firm near term. But in our opinion, and anyone retains any capacity, its medium and long-term outlook remains bearish. That's why we said we are bearish on metals short term, but bullish long term. They move opposite. That's why we love the DXY. Ladies and gentlemen, if you look past the last 30 years, every time the U.S. 2-year crossed above the Fed funds rate, ladies and gentlemen, the Fed's next move was a hike. Write that down. That's massive. So if you look at the U.S. inflation, it's rising. Equity investors, they're not going to respond positively to the Fed policy, okay? Regardless of whether it hikes or stands pay. A meaningful equity sell-off, in our opinion, is going to be needed to generate enough disinflationary pressure to offset the inflation impulse from oil and food. We've been going over this for some time. If you look at the equity markets internally, they're weak. Looking in March, the global equity rally has been very narrow. It was led by AI and semiconductors. Emerging market local currency bonds and emerging market sovereign spreads, they look really vulnerable. They're looking very, very weak historically. So if you look at global share prices, ladies and gentlemen, and bond yields, they're not likely to rise simultaneously for much longer. This is run out of gas, in our opinion. So if you look at a further rise in yields, it's probably going to produce a drop in the stock market. We're preparing for that. So if you look at a meaningful tumble in share prices, that's going to eventually lead to a decline in bond yields. We're positioning ourselves for that, ladies and gentlemen. We think the Fed's is caught between a rock and a hard place. They're really in a rock and a hard place right now. So they got a dilemma. Do they raise or don't raise? So if you look at the 2-year yield, it's moved above the Fed funds rate. The odds of a rate hike have risen substantially. That's what we think. That's because over the last 30 years, whenever the U.S. 2-year bond yield crosses above the Fed funds rate, the Fed responds with a hike. I repeated myself. I'm trying to drill this into your head. Write that down. If you go and look at the other side of the equation right here, whenever the 2-year Treasury yield fell below the Fed's fund rate, the central bank cut rates. This is what people and the gurus and the amazing people that talk on TV talk about. If you write that down, you're not going to watch TV no more. The negative correlation between U.S. share prices and 10-year bond yields, that relationship may stop. But right now, rising interest rates are quietly negative for the equity markets as a whole. So what we're paying attention to, and anyone takes any capacity, we're paying attention to U.S. core consumer price inflation. That's about 2%. We're looking at PPI. That's if you take out energy and food, it surged 5.25%. It's really growing. But if you don't, it's 6.6 on an annualized basis in April. So risks to oil prices are skewed to the upside in the near term. It's being moved by tweets. Peace, kumbaya. We gotta teach them a lesson. We gotta teach them a lesson. Goes up. That's why people are getting cut up like sushi. But in our opinion, what we're telling people that retain any capacity, an end to the issue with the Strait of Hormuz crisis, it's not imminent. The conflict, we believe, is going to have a lot more drama before it stops being dramaful. There's going to be a lot more additions to this freak show movie we're seeing, unfortunately. But if you look at the correlation between oil prices and U.S. bond yields starting in this year, it really shows that a drop in U.S. bond yields is not in the cards, unfortunately, ladies and gentlemen. So inflation's rising. Equity people are going to react negatively to that. And everyone's watching what the Fed's going to do. We know that yesterday. Whatever they say today, you've got to look further downstream. So that's a big thing right now. Whether they're going to, if the Fed does not hike, the bond market probably sell off. It's rough right here when you look at all this and how do you try to navigate this? Because this sets the tone for all the other markets, ladies and gentlemen. Trying to take the PhD out of PhD for everybody to see this. So if inflation's rising, economic growth is robust. The longer the central bank delays hikes, the more it must raise rates at a later date. Write that down. But in other words, in my opinion, the central bank is falling behind the inflation curve, and it's bearish for stocks and bonds. I don't even know how they're going to make heads or tails of this, but everything comes down to the price and yields of bonds and share prices. That's what you got to pay attention to. So if U.S. bonds yields continue to rise, the U.S. stock market rally persists, in our opinion. On the flip side of that, if U.S. share prices tumble, the U.S. bond yields might decline. So when you look at this, and I'm going back and trying to look at charts over the last 40 years. In bear markets and U.S. bonds, they did not end until there was a major turmoil in the U.S. economy or financial markets. That's what we're paying attention to. That's very, very important. So if, again, over the past 40 years, bear markets and U.S. bonds did not end until there was a major turmoil in the U.S. economy or financial markets. So we don't think that this is going to be any different right now. So I don't think that the stock price bond yield correlation will remain negative in the near term, long term. But I think as long as the markets perceive the Fed as having fallen behind the curve, which is important, rising bond yields will be negative. So that's going to affect everything because the risk on, risk off plays of every market is being derived from this relationship right here. You made it to this point. You really have an edge right now. I can't believe we give this away for free, ladies and gentlemen. I really can't. But in this current situation, a drop in equities could really bring down U.S. bond yields considerably. So if you look at everything, what's happening right now, it's pretty rough right now. U.S. households, they're getting hurt right now. And if you look at the things that we pay attention to, we're paying attention to data center builds out. If you look at hyperscales capital investments in data centers, that's not going to stop until share prices come down. But look at the massive commodity markets that are being driven to buy those to basically fuel the growth. So you really need drops of everything to unleash deflationary forces in the broader economy. But that's not going to happen as data centers are being built because they're sucking up everything. They're sucking up resources to build these things again. So if you look at oil, higher oil prices have led to higher food prices. Bottom line, the U.S. has got issue right now. In our opinion, only drawdown in stocks will halt the ascent in bonds. The bond market does everything right here, right now. That is the biggest thing right now that's doing everything. So to me, there's a big problem here right now. The S&P 500 advanced decline line is rolled over despite the high equity index marking new highs. Ladies and gentlemen, there's a lot happening right now. None of this is financial advice, just my opinion, and it retains any capacity. I went over all this, and if you want to understand how to take advantage of everything I just said, and you're looking to capitalize off of this chaos, come and join the Crypto Public Desk monthly. Look, the bond market controls everything right now. The dollar controls everything right now. Until this shakes itself out and until there's clean line of sight, we're going to be in the what if forest going up and going down. You pay attention to the dollar, the DXY, bond yields. That keys off of everything else. If you want to see what we're doing and how we actually give out positions for this, come and join us at Crypto Republic Desk Monthly. But as with that, ladies and gentlemen, I love you all. I'll see you at 7. I'll see you on the front lines. It's contents for informational and entertainment purposes only. Should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions always. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You got two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves that it'll happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink because the world is distracting you with noise, while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. You move now, be remembered. This is not the end of the story. This is just the beginning. Let's open your eyes, smash the like button, ring the bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Public. We break down the major global banking trends shaping digital assets today. We give you content, clarity, and research you can use. Don't just watch it happen. Stay informed, stay in the public. I love you all. See you at 7.